Okay. Okay, so we are working on the second learning objectives for chapter 2. So this is about identify and calculate ratios for analyzing companies' liquidity, solvency, and profitability. Okay, so what's a company's liquidity? Okay, liquidity. So a company, they have things, we call it current asset, such as cash, accounts receivable, and inventory, supplies. If you remember from the previous lecture, we have those items. Those are considered as current asset. Okay, so those are the assets can be quickly converted into cash, probably within 1 year. Okay. So for example, right, cash is already cash, right? What about accounts receivable? Well, it won't take you more than 1 year probably to collect the money from the customer. So as soon as the customer pay you, right, you receive the cash. So that account receivable has been converted to cash. Okay, and the inventory, okay, the inventory can be converted to cash when the customers buy the inventories, right? So the customer will buy the inventories with cash, right? So those items can be converted to cash within a year or like a life cycle. So those are current assets, okay? And the same idea, right? You have a current liability, right? So these are the debt liabilities you have to settle within a year, okay? So you don't want all the wages to your workers for too long because your workers need to make a living, right? They need money to survive. So you think about this. An organization has current asset and current liability. The question is, will you have enough current asset to cover your current liability? Okay. So if you have enough current asset resources that can be converted to cash within a year, and for the same period of time, that cash is sufficient to pay off the debts, the current debts. So that would be considered as a good situation, right? So that's when we talk about the company's liquidity, that's what we are talking about. What is the company's solvency? Solvency is how company is likely to be bankrupted. Okay. So this one often refer to the debt level relative to the asset level. If the company have a high proportion of debt, so the company's solvency, right? That's a concern. Profitability, that tells you whether the company is making money, right? So there are different ways to measure profit, okay? So in this learning objective, we are going to learn a couple of ratios will help us to make some basic assessment about how company is doing in terms of liquidity, solvency, and profitability. And we're going to learn how to calculate the ratios. Okay, so we have financial statement that contain lots of financial information, okay? You could use this data, okay, to do some comparisons, okay? So for example, you could do a vertical comparison, So you are dealing with the same company. A vertical analysis could be, okay, how does everything expenses compare to sales dollars? Okay, so what's the percentage of accounting fee to the sales revenue? Okay, maybe you spend 2%, 3%, the sales revenue, right? Dollar amount as a for accounting fee, right? So those are one way to analyze. And you could compare with the industry, right? If you are like a dentist clinic, right? You have your own financial information, right? But then let's say profitability, right? Maybe 20%, okay? Let's say you have a sales $1 million, but your profitability is only $200,000 a year, which is 20% of the revenue. How does that compare to industry, right? Compare to your competitors, the average of the industry. So maybe the average of the industry, the profitability is 30% or 40%, and you only do 20%. So there's something is wrong with your cost control, right? You are probably hiring too many people. You probably didn't operate your business very efficiently, right? Intercompany comparison. So you compare your company with a competitor, only one competitor. Or you can compare to yourself year by year, right? So you can compare if you are doing a better academic performance. So this year, your GPA is 3.0. Compared to last year, your GPA is only 2.5. So you are doing really well this year. You made quite a bit improvement, right? Progress. So you could compare to yourself from one year to the other, or you could pick a competitor, compare yourself to the competitor, or you can compare yourself to the average of the industry, okay? So the idea is sometimes if you only have your own information, you don't learn too much, right? You don't learn too much. Only when you compare to others, you have a better idea, right? So, because otherwise, if you get a 60% in this exam, you think you did a good job. Well, everyone else in the class get 90%, right? Okay, so let's see. If you are asking those admin-related questions, please stay until the end. I'm going to address your questions at the end of the lecture. Right now, I'm just have to spend the time doing the lecture, okay? So this would be considered as ratio analysis, okay? Vertical analysis, horizontal analysis will compare to your competitors or average of industry. So ratio analysis, okay, ratio analysis. So we talk about the profitability ratios, liquidity ratios, and solvency ratios, okay? So what's the profitability ratio? So this ratio measures a company's income or operating success for a given period of time. What is liquidity ratio? It measures the company's short-term ability to pay its maturing obligations to meet unexpected needs for cash, okay? So in a short term, right, in a short term, does the company have enough, okay, resources to pay its maturing obligation? Solvency ratios is the company's ability to survive over a long period of time. Okay. So you can see these ratios will be really important and interesting to the managers to help give the managers some useful information, right? So let's start with liquidity ratios, okay? So we have two ratios here for you to calculate, and basically the first one is called working capital. Working capital. So how do you calculate working capital? You use current asset minus current liability. Okay, so you take the difference. So that's one. The second one is current ratio. So how do you calculate the current ratio? You use current assets divided by current liabilities. So the first one is minus, okay? The second one is a division, okay? So the idea is the result, the higher is generally better, okay? So if you think I'm comparing two companies, one company's current ratio is higher, so in general, that company is in a better situation. So that's the liquid ratio, okay? And solvency ratios. Solvency ratios. Again, this measures companies' ability to survive over a long period of time. So this one ratio here is called debt to total assets. Okay, so you use your total debt, total liability, divided by your total assets. So generally, this number is lower. The lower is the better. Okay, you wish to have lesser proportion of asset in your business. That's considered as a better situation. Okay, and the last one here is the profitability ratios. This one measures the income or operating success of company for a given period of time, usually 1 year. So within the 1 year, how does the operation do? Is that very successful? So here we have two ratios. The first one is the basic earnings per share. Okay, basic earnings per share. So for each common share, how much earnings was made? Okay, how much earnings was made? So basically, you have a division here. Income available to common shareholders. Okay, the income that is available to the common shareholders. The reason why it talk about the common shareholders, remember there are also preferred shareholders. Okay, so the income could be divided among preferred shareholders and the common shareholders. Remember, we talked about the common shareholders are the shareholders who have voting rights. Therefore, they have ownership of the company. The preferred shares holders, they do not have voting right. So they do not own the company, but they still receive dividends. They still receive the income. You couldn't find 2.2. I will find it for you after, okay? After I finish this, I will find it for you. And then So the income portion available to the common shareholders divided by the weighted average number of common shares. So how many numbers of common shares owned by them. So you figured out what's the basic earnings per share. Okay. So this is important information the investors will read, right? When they try to make a decision which stock to buy, they would pay attention to this ratio here. The second one is the price earnings ratio. Okay, price and earnings ratio. So it's also a division. So the numerator is the market price per share, right? You can find what is the market price per share on that date, divided by the number you just calculated, basic earnings per share. Okay, basic earnings per share. So that is the price to earnings ratio. Generally, the higher, the better. The higher, the better. You hope the market price to be high, right? For sure. So the higher, the better. You wish the income available to common shareholders is high. So if the numerator is high, so the ratio will be high. So the idea is these two ratios, the higher, the better. Okay. So now I have introduced you with these different ratios. Does anyone have any question about these ratios? Okay, so I will give you a minute while I'm going to find that for you. So here, okay, right here. Okay, it's there. So does anyone have any question in terms of these three ratios? If you have no question, let's do some practice. So let's use our previous slide. So we have a previous slide. Okay, so where is it? Here. Okay. Okay, so here we have some informations. Okay, so this is my statement of financial position. So it gives me the asset information here, and it also gives me liability informations. Okay, liability informations. So now you can do some ratios calculation. Okay, so calculate the working capital and current ratio. Okay, just to help, I'm going to make them on the same. Okay, I will put into the same screen. So you can give it a try, see if you understand this. So this is my asset, okay? And I also need to get my liability here. So now they're together. Okay, let's see. Okay, so please do the current ratio and working capital. So do that calculation, please. And the working capital equals current asset minus current liability. The current ratio equals current asset divided by current liability. Okay, so I have some student already told me the answer. Kristen got the answer. So your working capital current ratio, okay. So anyone else? So I'll give you 5 minutes to do the calculation. How do you calculate the working capital? You take the difference, current asset minus current liability. And what is your current ratio? It's your current asset divided by current liability. So is lower better or higher better? Right? Are you guys working on this? Okay. If anyone, I'll give you 2 more minutes, okay? Okay, so I have some students sending me numbers. Okay, so it doesn't matter if you get the number right away or wrong. The point is, you try it on it, right? You first try it. If you get it right, that's good. That means you probably have good understanding. If you're wrong, that's fine. That's a learning process, right? I have all kinds of different numbers. So students send me private message. I have all kinds of different numbers. So it's interesting. Okay, so I'm gonna do this with you guys. So first of all, we want to know, so we know that working capital equals current asset minus current liability. We also know current ratio equals current asset divided by current liability, right? So to know this liquidity ratio, so both of this is called a liquidity ratio. So both to calculate this, we need to know what is my current asset and what is my current liability. So here I want to ask you, is equipment a current asset? Is this a current asset? Equipment? Yeah, I see a bunch of no's. Okay. Okay, equipment is no, right? Equipment, you can use it for many years. In last lecture, we talked this as a long-lived asset. Is particularly we call it PPE, property plant equipment, right? So that's a long-lived asset. It's not. It's a non-current asset. So now this is my current asset, right? These are my current asset. Okay, so if I add this up, what should I get? Let me do this. 2. That's gonna be maybe 4 and 6150. I think it's 24,150. Okay, so that is my current asset. So what's my current liability? So accounts payable, that's you pay your supplier. Salary payable, you pay to your employee. Interest payable, you pay to the bank. Deferred revenue, this is the situation where we talked about this. They pay you cash in advance without you delivering the service or the goods yet, right? And the bank loan payable. So this is all current asset, right? This is all current liability. Okay, so now my total liability is also my current liability. It's this number. So now what's my working capital? The difference. So that will be 5, 2, and 2, 5, 1. So 15, 2, 25. Is bank loan payable current liability. So normally, if it's a long-term liability, we call it a mortgage. Normally, mortgage would be your long-term liability to the bank. Bank loan payable, here I assume this is a short-term loan for $5,000. Often if you have a larger balance, right? Let's say I borrowed $1 million, right, from the bank. So that would be, you probably cannot pay back within, well, you would hope that you can pay it back in 1 year, right? That means you are super rich. Like $1 million is like pocket change, right? But normally, if the balance is very large, right? So relative to the eyesight level, you will know that this is long-term liability. But like this one is only $5,000. You probably can easily pay it. So here we assume this is a current liability. So am I correct? The working capital should be 15 to 25. Am I correct? Okay, and now what's my current ratio? My current ratio is a division. So maybe someone can use calculator, help me out. 24150 divided by 8925. So it's something between 2 and 3, probably. It's a number between 2 and 3, 2.7. Thank you. Okay, are we okay with this one? The calculation of the liquidity ratio? Now tell me, is this a good one or bad one? Do you think what can we say about this company? We can say this is a good liquidity ratio or bad liquidity ratio. Do they have the short-term ability to pay for the maturing liability? Do they have enough money to pay? Do they have enough current asset to pay for the current liability? The answer is yes, right? Yes. See, it's a positive number. If your working capital is a positive number, that's good. And if your current ratio is more than 1, that's good. Okay. So anyone have any question on this? If you understand this, please give me a sum up. 1, 2, 3. Okay, awesome. Good. So I will move on. So now calculate the long-term ability to survive, which is the solvency. So the solvency, the ratio I was showing you is debt to total asset. So your debt to total asset ratio. You use total liability divided by total asset. And lower is generally better. Okay, so tell me here, what is my debt to total asset ratio? 0.31. Did everyone get 0.31? So my total liability, so this one is the liability to total asset. I use my total liability divided by my total asset. So you get 0.30, 0.31, right? So what does that mean? What does that mean? That means if your company have $100 asset, how many of that will be liability? if you calculate it's 0.3. Okay, that means if your asset of the company is 100, how many of that is liability? How many of that is equity? That's correct. So 30 is for liability, 70 is for equity. So liability is 30, asset 100, that is your 30%, 0.3, right? Okay, so do you think this is good? So for business, 30% is my debt, 70% is my own money. Do you think my company will have a long-term problem to survive? It's good, right? It's better than the opposite, right? Think about a company have 70% of debt, right? If the company have 70% of the debt, it could be, we call it heavily leveraged. It could be risky, right? Because, if interest rates went up, right, just like right now, right, you had to pay a lot of more interest expenses, right? Do you have enough cash flow? So the idea is the proportion of the debt is lower, it's better, right? So 30% in the general business sense, that's good. Okay, that's good. If the proportion is 90%, that's a little bit concerning, right? If you have too much debt, that's a little bit concerning. Okay, so that's this one. Before I move on to the next learning objective, do you guys have any question here? No? Okay, good. So I'm going to move to the next one. Did you guys see I have this big like lines crossing my screen? Did you see that? Okay. Yeah. This is a little bit crazy, huh? Okay. I think some students probably accidentally draw this line this lines. Okay. Let me oh yeah, I see the student just draw one. Yeah, some student draw this. So let me think, how should I erase this? Maybe I should disable that function, right? If I disable that function, that won't be a problem. So let me stop recording.